Accounting for materials. Direct costs are those related to the work you do and don't include overhead or other expenses. As sales increase or decrease, so do direct costs and gross profits. The largest direct costs to a builder are subcontracts, materials, and labor. Materials include everything you buy that will be installed on your jobs. Both material used from your yard inventory and material delivered directly to job sites by the supplier. Freight charges on that material are direct costs because they're part of the cost of getting the material into the structure. Indirect costs are the expenses of taking a particular job that don't involve any work on the job itself. Indirect costs include freight, administrative payroll, and small tools, anything not billed to a specific customer. Overhead is the cost of the items you need to conduct business that you can't charge against a particular job. These include office space and utilities, clerical help, small tools, printing, postage, and the like. Overhead remains fairly steady, regardless of how busy you are. Direct and indirect costs change as your volume changes. This chapter examines direct material costs and shows how to use ratios to analyze the effectiveness of material handling. Direct labor costs and payroll records are the topic in Chapter 11. And materials handling and control. The most professional builders pay a great deal of attention to materials handling and control. That's because about half your direct costs will be for materials, and it's estimated that about 8 to 10% of labor costs on residential construction are spent just to move materials from the curb line to where they're installed. But that's just the beginning of the problems caused by sloppy material control. Early deliveries mean overstocked yards, and on-site vandalism, arson, theft, and weather-related losses. Chronic overstocking increases your costs for insurance, handling, property taxes, and distribution, and can mean losses from obsolescence. Late arriving materials cause expensive delays, interrupt your job schedule, require rescheduling of subcontractors, and create costly idle time. Without a good materials handling program, even the best builders lose profits. Agree on delivery terms with your suppliers. This is as important in controlling costs as large discounts, lower prices, and quality materials. Suppliers who are dependable in meeting your delivery dates will save you more money than discount suppliers who can't deliver on time. A well-organized builder needs to know exactly what he wants and when. Develop a firm on-site schedule. Stick to this schedule, and the job will move along smoothly and profitably. Idle time is cut, and deliveries are there when you need them. Know as far in advance as possible what will be needed at each site on a day-to-day basis. Volume buying is a big part of a good purchase plan. A good supply of materials and shop inventory gives you a contingency reserve you can use when deliveries are short. Volume purchasing also brings discount terms, which can make the difference between high and low profit. But discounts are valuable only if you can justify the purchase. Be sure you can use the discount material in the reasonably near future. Otherwise, your yard becomes loaded with dead inventory. This extra handling and storage means higher operating expenses and an unnecessary commitment of your capital. You can have a smooth flow of materials through the yard if your operation is diversified. For example, Johnson Construction does both bid contract work and repairs and improvements. It can order and use a steady supply of inventory, switching from one type of job to another during slack periods or to meet varying demand. But Johnson Construction can still overstock if they make large materials purchases that they can't use on upcoming jobs. Controlling purchases. Your mix of jobs should keep your inventory moving steadily, but you need control over materials entering your yard from suppliers. Written purchase orders are the most simple control device. Specify to your suppliers, wholesalers, and shippers exactly what materials you want, when you want them, and where you need them delivered. That's how you avoid misunderstandings and late or early deliveries. You can authorize your field superintendents or supervisors to make purchases on your purchase order form. This may be your only way of controlling job costs before you are committed. Control of the form itself should help you cut down on unauthorized purchases. With a purchase order system, you often receive a confirmation from the supplier, including terms and conditions. This lets you compare suppliers' terms to find the best place to buy specific materials. Figure 10%-1 shows a typical purchase order. A purchase order form should include the following information: billing and delivery address, a pre-printed number, order and delivery dates, shipping instructions, including the carrier and delivery terms, quantity, description, unit price, and total price for each item. Sales tax. Authorized signature. You need at least 3 copies of the purchase order. Distribute copies as follows: original and first copy to the supplier. The supplier will return the first copy to you as written acknowledgement confirmation of the order terms. Second copy. For the office file, keep the file in numerical order. Accounting copy, to be matched to the invoice when received. Keep these in alphabetical order until bills are paid. Check the prices on the invoice against purchase order prices. This can also serve as a follow-up copy, first filed by due date for expediting purposes, then forwarded to accounting with the packing slip when the order is delivered. Fourth copy, optional for receiving purposes if necessary. You may want a document in hand when the delivery arrives at the job site to confirm that the order is correct. A well-documented purchase system provides you with a ready reference, good records, and better communication with suppliers. Purchase orders are the basis of a smoothly run delivery schedule. Summarize your purchase orders on a purchase journal so you can analyze total company material purchases at a glance for a given period. Organize your summary in purchase order number order. See Figure 10-2. A properly designed form provides both inventory summaries and breakdowns by job. This is a good way to compare budgeted spending to actual costs. The first 3 columns are for date, PO number, and total purchase. The next columns show the distribution of these costs. The first distribution column, inventory, is for purchases that will go into your yard inventory. You control materials purchased and delivered directly to each job site using the purchase date and purchase order number reference as a distribution guide. You know what you need for each job in the immediate future. This form helps route deliveries where they are needed and keep the inventory levels adequate for your work output. It helps keep down unnecessary material purchases that. Figure 10%-2 purchase journal. Cause timing problems and cash shortages. This journal also assures that your jobs are allocated the right amount of materials from the suppliers on the right dates. Some builders use the purchase journal as a source document for accounting entries. Purchases are treated as accounts payable, and the entire purchase journal is used as a supplementary accounts payable ledger. But using the accounts payable and check register method discussed in Chapter 9 is more effective than using the purchase journal as an accounting document. The 2 procedures are not compatible. The real usefulness of a purchase journal is for better control of your inventory. But if your purchasing system requires that you use a purchase journal as an accounting document, here is the entry you must make each month to record purchases. As purchases are billed and paid for, an entry must reverse the one above. Record all purchases in the purchase journal. Be careful to code all material payments correctly. If payments aren't entered in the purchase journal, you'll overstate both the liability for accounts payable and the materials purchase accounts. This is an example of a troublesome accounting procedure. It creates more problems than it solves. If you use a purchase journal, be sure all purchasing transactions go through it. Controlling inventory. Controlling your inventory requires a purchasing plan that's in line with a strict inventory level policy. How much do you need to keep on hand? And of what materials? Lack of planning and control can leave you with too much or too little material at any given time. Having too much ties up working capital that could be better used. Keeping too little material on hand can cause expensive delays. You can't tell exactly what piece you'll need tomorrow or next week. Keep a reasonable amount of surplus materials on hand to save time and allow you to bring in more short-term contracts. Establish minimum and maximum levels of shop inventory, then stay within those limits. To do this, you need to know what you have on hand. This means keeping track of your inventory on a perpetual basis. Purchase orders summarized on the purchase journal tell you what has gone into inventory. But that's only half of the equation. You also need a systematic way of knowing what comes out. If you carry more than a few $1,000s worth of inventory in your yard, every piece of material drawn from your yard should be documented with a requisition. This cuts your losses and controls your stock. Figure 10-3, stock requisition. Figure 10-3 is a stock requisition. The information needed to complete this form includes the date, job number, material description, number of items, price each, and total amount. The amount should be equal in value to the amount at which items are carried in the inventory. We'll talk about valuation a little later in this chapter. Near the top of the stock requisition are two boxes labeled Issued and Returned. When materials are taken from inventory, check the Issued box. When materials are returned to inventory, check the Return box. You can also use the requisition form to generate a purchase order to replenish issued items. To keep a running account of inventory, carefully divide your requisitions into issues and returns and record them by date on an inventory form. See Figure 10%-4. You can keep a running inventory on a daily, weekly, or monthly basis. Beginning with a physically counted balance, subtract issues from inventory and add returns and orders received. You need to take a physical count from time to time to determine whether your requisition procedure is working. Use that occasional physical count as your beginning balance for the next inventory cycle. Try to take a count more often than once a year. If your inventory level changes greatly from month to month, look for low levels as a good time to make a count. A good way to check inventory is to count different categories at different times, rather than taking a whole count all at once. Categorize your materials and count each category at a different time. This requires carefully marked purchase orders and requisitions with the category code numbers. Valuing inventories. Inventories are usually valued on some type of cost basis, since the methods used to report sales, profits, and yields are all based on actual costs. Job estimates are based on cost as well, so it's logical to maintain your inventories the same way. There are 3 cost-basis valuation methods worth considering. The right one for you depends primarily on the size of your average inventory. A specific cost, materials are labeled with their exact purchase price or cost. As they're used, you can read this cost off the labels and assign it to the cost summary of the appropriate job. This method requires the individual labeling of each piece of material in the inventory. First in, first out. The first materials purchased are assumed to be the first ones used. The amount charged to jobs as the materials are used is the earliest price paid for the materials on hand. Last in, first out. The latest materials purchased are the first ones used. This is the easiest way to maintain a perpetual inventory because you don't have to label stock or look up prices for materials you purchased long ago. You simply use the current market value of material as it's used. There are 4 major inventory categories. They should be distinguished from each other, since you may have to keep separate records unless all your materials fall into the first category. Raw materials. This includes all direct purchases for use on various jobs. Supplies. This could include items like nails, bags, or boxes. Work in process. You need this category if you fabricate in your shop. Finished goods. Products that are ready to sell in a prepared state fall into this category. Finished goods are different from raw materials because they've been processed to produce a completed item. Some builders who do shop work keep inventories of both shop materials and job site materials. This means they need a complete requisition system for each site, unless they take a physical count regularly. You can avoid this problem if you consider goods delivered to construction sites as out of inventory and thus committed to the jobs. Analyzing materials and inventory. There are 2 principal ratios used to judge whether the level of your inventory is too high or too low for the volume of work you do. One is the cost of goods sold to average inventories. The other is sales to inventories. The sales to inventories ratio isn't a precise indication of effectiveness because inventories are based on the cost of materials and sales are based on a computed cost plus profit. But you can use this ratio if sales are stable from month to month. A far more useful ratio is the cost of goods sold to average inventories. The cost of goods sold represents all direct costs, adjusted for the change in inventory levels. Here's how to calculate it. Find the second part of the ratio, average inventories, by adding the balances of the physically counted and perpetual inventories from each month and dividing by 12. Shown below are physical inventories based on the calendar year, but partnerships and corporations can base their physical inventories on the fiscal year. Since there are 4 possible types of inventories, there are 4 variations on the ratio. Raw materials, ratio equal to cost of raw materials used, average inventories of raw materials. Supplies, ratio equal to cost of supplies used, average inventories of supplies. Work in process, ratio equal to cost of goods completed, average inventories of work in process. Finished goods, ratio equal to cost of goods sold, average inventories of finished goods. Compute these ratios regularly. Monitor trends as they progress and take corrective action as necessary. A low ratio can mean that your average inventory is too high. A high ratio can mean that you're maintaining too small an inventory and may result in lost sales. The correct level depends on your operation and its volume. Good inventory control does the following: minimizes investments in capital inventory, reduces the need for storage space, reduces exposure of materials to theft or arson, reduces taxes, insurance, and other costs of maintaining an inventory, lets you take advantage of discounts, reductions, and special prices through volume purchasing, provides needed materials fast, helps you avoid construction delays, minimizes obsolescence losses. It helps you track the amount of material on hand while reducing the cost and time of physical counts. The non-system system. Whether you account for materials by hand or with a computer, the important thing is to install the procedures you need for your particular business. A system that does more than you need is as ineffective as one that doesn't tell you enough. Many builders can get by without any formal method for accounting for materials. They simply work from job to job without a material tracking system. You don't need a system if you don't keep inventory on hand. Many contractors in different specialties order materials for specific jobs and have them delivered directly to the site, or they pick them up as needed and take them to the site themselves. Without inventory, there's no backorder problem. There's also no need to count inventory, insure it, pay for storage space, or deliver it to job sites. You may still have to analyze material costs as they relate to total job costs and profits. Some builders depend on supplier discounts to make their material margins instead of marking up materials substantially. This is fine as long as you can get an acceptable discount, which means you pay by the deadline and order a regular volume of materials. If you don't qualify, you need to add on some markup when you bill your customers. Analyzing your costs versus profits will tell the story. Here's an example. Say you've noticed that you make a higher percentage of profit on smaller jobs, or jobs requiring more labor than materials. This is an indication that you're not giving material costs due consideration. Since you have to invest capital in materials during the job, you should mark up your costs to compensate yourself. How much? That depends on the local custom. If you go too low, you're cutting into potential profits. If you go too high, you'll lose business to more competitive builders. Your records will help you make the call.